Good day, all. Ira Epstein with your financial market wrap-up for this Thursday, October 3rd, 2019, and we're approaching 3:20 p.m. Central Daylight Time. That means the settlement prices and the stock indices are in, so I'm getting this going right now for you. And it was a good rally. For those of you that get my daily commentaries in writing, you know that I was saying, watch out. You're approaching those 200-day moving average of closes on this break, and that's where I'm looking for support to come in. You didn't quite get there. I was on Bloomberg this morning, TV, in fact, talking about it, and the market reversed. And why not? It had a bad piece of data. That's in the marketplace. And when I say bad piece of data, if we're looking at all these ISM numbers and you're looking at non-manufacturing now, and you're seeing that part of the industry is just this close to rolling over where there's contraction in jobs and so on, you realize the Fed's going to be looking really hard tomorrow at the jobs numbers. And the question is, if the job numbers are 145,000 or more, right now going in, the market's got nearly an 89% probability of a rate cut this month. What happens if the number's a strong number? It probably drops that and the Fed will try to buy time. That's my guess. It'll change as we get more data towards the next Fed meeting, but that's the guess. So today, I think what the market did is some bit of profit taking. If we take a look, we can still see that on a weekly area chart, we're down 52 points in the S&P, and I'm going to call the thrust down because you're still under the 18-week moving average of closes, which is 29.48, 37 points away. When we take a look at the daily bar chart, you see how the market came down, didn't make it to these lows. These were very important lows, got close to them and did a reversal today. The trend is still down as you have lower highs, and yes, these are all lower highs and lower lows. Therefore, the trend is down. Here's that 200-day moving average of closes. That's what I was writing about in my newsletter, and you only get that newsletter if you're one of our subscribers. And I was saying, be careful. This market's proving that, each time it's been going down there, that's where it's able to grab some traction. Well, thinking about the importance of tomorrow's number, I think the trade said, okay, we're close enough and you got to bounce. First resistance, 29.29 if you keep going up. The secondary's 29.79 and a half figure, and that number will drop a little tonight because of how the settlements go. You're going to drop one of these numbers and replace it with a lower close back here. When we come to the Bollinger Band, the market was outside of the Bollinger Band yesterday. You can see how the market finished. You finished at 28.80. The lower Bollinger Band was 29.20. 5% of the time you stay out of the Bollinger Band. So if the market rallies, often they're trying to get back within it at some point. Well, that number today, we finished at 29.11. 29.08, 70 is the lower Bollinger Band. So this rally carried not too far at all, just got back within that number, and that puts the market very much in a position of saying, okay, we have a downside breakout. If the number tomorrow is bad, you could ride that lower Bollinger Band. That's a term that I often use. I have no idea what tomorrow's number is going to do, and I always warn people, when you're going into what I call big numbers, and this is a big number, you've got to be careful because the algorithms take over the first few minutes of trade, sometimes up to 10 minutes, and you get stepped on all over the place. Be careful. I'll stay with what I know. Oversold market, couldn't quite make it to the 200-day average. If you rally, two levels of resistance, the 100-day, the 18, and to negate the downtrend, and it would not start an uptrend. You'd have to get over 29.94.50 because that would break the pattern of lower highs, lower lows. When we get to the NASDAQ, same thing. You made a run for the lower Bollinger Band. The finish today was 76.58. The lower, and I'll show you this right here. Here's the lower Bollinger Band. Yesterday you closed 75.46. That number then was 76.23. The spin around today carried you back over the Bollinger Band, so I think it was a short covering day. The resistance points still come in, the 100-day and the 18, but you are oversold going into a major report. Unfortunately, the Dow doesn't have 200 days yet of moving averages on the futures that I can put up there. That's a real not good thing. I wish that we had that. But you've got the lower highs, lower lows. Unlike the other two indices, this market was unable to get and close over that Bollinger Band bottom. So it's 2 days in a row out of it. It gives it a 3% chance tomorrow of closing under that band. As I look at each consecutive close under the band, let's be sure yesterday was under it, 25,985, 26,349, and today again under it. So what that tells me is that should you drop tomorrow, you could get another 3 days before you get to that, what I call 0% chance. Each consecutive day takes one of the percentage points, from my point of view, away from it. Now, you'll say, what happens when you go to 6? It doesn't matter, or 7. I've seen that. It's rare, very rare. It's a percentage. If you're trying to catch a trend and you want to be short, maybe you can do better than selling under a Bollinger Band. That's the idea. If you are short, what are the odds of you getting a further break? And you have to build that into your strategy. Why go into a major report? It's another strategy. When we get over to the Russell, you came back, finished 1486.80. That is over the Bollinger Band. So all we did, as far as I'm concerned, is get the market back in most of them, 3 out of the 4 indices, back into those bands. Pretty stiff resistance in 3 levels of the Russell. The 200-day in gray, the 100-day and the 18-day, all of the average of closes. Expect this 18-day average of closes to try to get under that peak as early as tomorrow. In the VIX, well, the market was up and over, as we talked about. I think the pros went short 2 days ago, right here at that top. I said yesterday, are they going to be strong enough to hold this another day? Well, the market finished at 1912, back under the Bollinger Band. I can't answer that question if they're strong enough or not. To me, why go through these reports? But we have to pay attention here to the 1612, 1588 level. Now you've got, if the market breaks down, that is the support, and that's where I would expect pros that wrote calls against that number to come out of them there. I don't know that they'll go through the report. You know, you've got to make decisions, and why step in front of a freight train? In front of the T-bond market, you have no pattern in terms of a charting trend. You have a lower low and a higher high. And if you take a look, you reversed here on Tuesday. You carried through on Wednesday. That puts the potential, the word is the potential, of the upper Bollinger Band there with an overbought condition, if you can get to it. You tell me the number you went right to when you stopped in its tracks. You not only stopped in its tracks, you got through it by up to 164.31, and by the end of the day, you're finishing back under that band. What happened when we went up to that number in the 10-year note? The same thing, the same pattern. So I'm questioning when that happens. First off, what I teach is the first challenge of a Bollinger Band is often where pros come out of the market, be it to the downside or to the upside. Second, do you go through these type of reports? I know what I think. That's up to you. TLT. In an uptrend, a bit different than we saw in the bonds and the notes, and right to that upper Bollinger Band and stop there. So now, are you rolling the dice? What are you gambling with tomorrow for the jobs data? You figure that one out, but I think the pros got out at that number. Then we have the dollar index, and the dollar index had 4 days in a row over the upper Bollinger Band, had a reversal right here that you can see where the market started coming down, broke down again yesterday. Where would you look for the first support zone? To me, it'd be what I call my line in the sand, which is that 18-day average of closes. That's the neutral number. Now, some traders use a 20 or a 21. I like the 18 for a whole myriad of reasons, but that's the one that I prefer. And if you take a look where the market went, got to a low of 98.30, 98.29.7 is called 98.30. So you always round towards the price. Right to that number, stopped on the money. I think these markets neutralized themselves going into the report tomorrow. In the euro, if it continues rallying, I'm looking for what the market can do with the 18-day average of closes. We still have the pattern of lower highs, lower lows. However, you're oversold as can be. You would hit your downside targets. You're getting a bounce. How that jobs number is going to go is going to weigh on a lot of these markets tomorrow. In the British pound, the market seems to like what is going on that Boris Johnson presented to both Parliament and to the European Union. Now, the Scots don't like what he said at all. I was watching today the reactions, and I am not saying he's got a deal of any type. All he's really done from what I'm seeing is taking the Irish backstop and saying, hey, instead of an open-ended deal, let's give it a certain date. The question is, what happens when that date comes? Because we know how politicians work. They do nothing until they have to do something. So what we did is we basically went from the upper Bollinger Band and the 100-day average down to the lower band 2 days ago. I think the pros, if they were short, got out there. I think if they were long, they began coming out here. They might have bought back on these breaks and been coming out. But up here, I think it's a real rough one. And certainly, when you turn the slow stochastic down, you put into play the potential for the 18-day average where it first stopped. And if it keeps going, maybe you get to that Bollinger Band, which you did, and now you're back to neutrality. A lot of neutral markets going into the U.S. data. So we knew that we had, gotten the Japanese yen, getting the safe haven idea that the U.S. economy is weakening. So yesterday you got to the 100-day average. The Bollinger Band is going to fall. That's what I'm pretty sure I told you yesterday. And it did. It came down a little bit. You got up today as high as 94.34. You finished at 93.98. Just under that number and challenging again in between the Bollinger Band and the 100-day average. I'm going to repeat what I'm teaching. I think the markets are neutral for tomorrow's number, and they'll figure out what to do after that. Bitcoin actually threw out a new sell signal today. Until today's high is taken out, you now look like you're getting embedded readings. Both numbers are under 20, both under 20, and both under 20. In addition, you have an outside day down. So if this market picks up momentum, a potential target could be your 73.75. There's two elements I'd be watching on it. You don't want to take out the high of an outside day up. That can always be very ugly, and it could set into place price and the 18-day average making a run at each other. Number two, you don't want to lose the embedded reading. Barring that, trend is back to the downside. In Brent versus WTI crude, well, the market's got a little bit of a lift when the stock market in the U.S. came back up and finally reversed itself. Now it's just sort of hanging here. I have not heard anything new between Iran, Saudi Arabia, and the U.S. at this point. When we look at the energies, I want to show you yesterday, you had missed the Bollinger Band, and there's no magic. You don't have to hit it. But, gee, you went down to it today, and you had a pretty darn good-sized reversal. The lower Bollinger Band's 56.44. You closed going to be near 57.65 at the end of the day. Let's go back to yesterday in the Bollinger Band. You got to 52.17. You hit that number, and today you're back and over that low point of the market at 52.31. Does that mean you can't go lower? Absolutely not. Are you going to get a bearish crossover where the 18-day average is going to go under the 100? You betcha you're going to get it tomorrow. All right, the way the math goes, you can't stop that. In the November gasoline, we're still working our way down. Does it have the power to get to the lower Bollinger Band, or does it run out of steam here? We're going to have to wait and see what the market wants to do. A lot of things are going to get impacted by the jobs data tomorrow. And in nat gas, well, how many days did we have under the Bollinger Band? Yesterday we finished 22.47. That's the first. This day we finished 22.83 under it. That's 2 days in a row. 3 days in a row, and on this day we finished 24.04 right on it. So a minimum of 3 days in a row. Gave you a 2% chance today, or a 98% chance, the way I figure the math on Bollinger Bands, that you're going to move to the right-hand side of it, and that's basically what you did. Is it bullish? No, no, no. This is just, maybe you make a short-term bottom here, but you're trying to embed, which means this area is still a very big resistance zone. You know, if you like what I'm doing here, you might want to sign up for our futures trading kit because it includes so much of what we have. I'm talking the charting data. I'm talking, you get our two different charting packages. You can have one that's web-based, you can have one that's Java-based. Then, within the contents, you get all this. be it chart patterns, trading rules, money management, technical analysis. Everything comes in here, and we've put it together in a way that I think you'll find very easy to work with. You can print out a lot of these things if you decide. We send you a link. It opens up right on your computer, and away you go with it. You talk about something for your financial library. I think this is pretty important. You're going to talk about primer kits on options. You're going to find cause and effect. Now, that's the speed of money moving through the economy. Volcker brought that out, Paul Volcker, that is, and then you learn how to work with that. Here's the pivot points, and of course we have the Arun series, which is a time and price movement relationship. Very, very important. Then with the permission of the Merck, what we do is we put up their educational brochures. We link you right into them for their quizzes, for their updated brochures. It's all right there. So how do you get this? And it's totally free to you. Simply go to our website, go to free offers, ask for the futures trading kit. You can click up here to get there, and you can always go the old-fashioned way. Call us. We do pick up the phone, and we'll talk to you. I'm Ira Epstein. You have a good day.